Ever wondered how credit works? It's like a financial ghost, isn't it? Well, let's demystify it together, shall we? In its most basic form, credit is a sort of trust. It's an agreement that lets one party provide money or resources to another party. But here's the catch. The second party doesn't have to pay back immediately. Instead, they promise to return or repay those resources at a later date. Picture it as a financial handshake, a mutual agreement based on trust. It's like saying, I don't have the money right now, but I promise I'll pay you back later. This trust is what fuels our economy. It allows us to make purchases today and pay for them in the future. It's a system that's been around for centuries and plays a crucial role in our everyday lives, whether we realize it or not. So in essence, credit is a promise to pay later for something you get now. But how does this credit thing really work? What makes it up? Let's uncover the three main ingredients of this financial recipe: the principal, the interest, and the term. Picture the principal as the main course in your financial meal. It's the amount of money borrowed or the remaining unpaid balance on your credit card. It's the big juicy burger you're here for. Next, we have the interest. This is the cost of borrowing that principal. Think of it as the side dish accompanying your burger. It's the fries that come with your meal, adding a little extra to the overall cost. Lastly, there's the term. This is the length of time you have to repay the principal and interest. Imagine this as the time it takes to enjoy your meal. You might wolf it down fast or savor it slowly. Think of it like a pie. The principal is your filling, the interest is your crust, and the term is how long you bake it. Now, what about this talk of credit scores? How does that fit in? Think of a credit score as a report card for your financial behavior. It's a number, typically ranging from 300 to 850, that lenders use to evaluate your creditworthiness. This number is calculated based on your credit history, which includes factors such as payment history, the amount of debt you hold, the length of your credit history, and whether you've applied for new credit recently. Why is your credit score important? Well, it can greatly affect the terms and conditions of loans and insurance policies. A higher score may mean lower interest rates and more favorable terms, while a low score might lead to higher rates or even an outright denial of credit. In essence, your credit score is a reflection of your financial reliability. It's a measure of how well you've managed your finances and met your obligations. Your credit score is like your financial report card. It shows how well you manage your financial obligations. So, we've unraveled the mystery of credit, but let's summarize, shall we? Credit isn't as complex as it might seem. Think of it as a trust system. It's about showing lenders that you can responsibly borrow and repay money. And it's made up of a few key components: your payment history, the amount you owe, the length of your credit history, new credit, and the types of credit you use. The credit score, a 3-digit number, is a quick way for lenders to gauge your creditworthiness. It's crucial to understand how it's calculated and what can impact it, as it can affect everything from your mortgage rates to your job prospects. And most importantly, remember that credit is a responsibility. It's not just about having a card to swipe or a number to boast about. It's about being financially accountable, managing your debts, and making timely payments. Remember, credit is more than just a card in your wallet. It's a tool, a promise, and a reflection of your financial trustworthiness. Use it wisely.